This is Nightly Business Report with Bill Griffith and Sue Herrera.
Stranger things. Netflix signed up millions of new subscribers last quarter, but it wasn't enough, and the stock falls sharply in initial after-hours trading. Helsinki Summit, a meeting, a handshake, and a news conference that certainly grabbed Wall Street's attention. Taking off. After a remarkable run, the global aviation industry appears ready to fly even higher. Those stories and much more tonight on Nightly Business Report for this Monday, July the 16th. And we bid you a good evening, everybody. Sue is off tonight. We begin with one of the best performing stocks of the year so far. That would be Netflix. But tonight, that fiery stock is cooling off because after the bell this afternoon, the streaming video company reported a disappointing number of new subscribers, missing its own forecast by more than 1 million members. Revenue disappointed, and the outlook for current quarter earnings and revenue was also not as good as hoped. That all pressured the stock in late-day trading today. Julia Borston has more now on Netflix numbers.
Netflix missing expectations on its all-important subscriber numbers, adding 5.15 million subscribers in the quarter. That's 1 million less than the company projected. Netflix CEO Reed Hastings saying the company had a strong but not stellar quarter, ending with 130 million subscribers in Q2. He attributed the miss to issues with the company's own forecasting, not to any increase in competition. But Hastings did address growing competition head-on, saying in his letter to shareholders, "We believe that consumer appetite for great content is broad, and that there is room for multiple parties to have attractive offerings." And Hastings says he anticipates more competition from the newly combined AT&T Warner Media and from Fox and its eventual buyer, Disney or Comcast. Hastings saying his strategy is to simply keep improving. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Dan Morgan joins us now to talk more about these numbers from Netflix tonight. Dan is a portfolio manager with Synovus Trust. Dan, thanks for joining us tonight.
Hi, Bill.
So first, on the all-important subscriber growth, they are blaming a flaw in their internal forecasting. Do you believe that, or is something else going on here?
Well, Bill, it's interesting. It's kind of the million-dollar question. You know, not only did they fall short for this quarter, but they guided for the next quarter also below expectations. And you know, is it an issue that, you know, content was too flat for the second half of this year? Is it because of the World Cup? Is it because of competition from Hulu and Disney and Amazon and so forth? So it's kind of like they didn't really answer that question.
Right.
They just said that their estimates or way of forecasting was off. So that's the million-dollar question, Bill.
And they were quick to point out that they didn't think it was a result of all the competition out there. But yeah, you have to pay attention to that competition as it grows. Amazon, Disney, and all the other services out there that are trying to get into the very same business. That has to take a toll at some point, don't you think?
Well, yeah, definitely. And in terms of, you know, you mentioned Disney and Amazon and Hulu and some of these other companies. The other big issue, too, going forward is, you know, they're creating content, but what about maintaining relationships with providers that have content? We know Disney pulled their content from Netflix. So that's another area going down the road for them that's going to be very challenging.
What are you doing with the stock? I know you own some. Are you adding positions? What are you going to do here?
Bill, it's not a big position for us. I think at this point, if I was holding Netflix and I owned it, I would watch it another couple of quarters. And obviously, the stock's going to pull back after this report comes out, so you may get an opportunity. But I think at this point, you may have to kind of rethink the strategy a little bit in terms of their growth. As you know, it trades at a very high PE multiple, so that multiple is going to have to ratchet back a little bit in regards to coming in line with these new subscriber numbers.
And, you know, acquisition costs have always been a problem for them as well. I mean, they spend an awful lot on new content, so to get those new subscribers, they have to spend even more. Is that a concern for you? And maybe I should ask it this way. Is that your biggest concern for Netflix right now?
That is a concern, Bill. Every time they acquire a new subscriber over in the international markets, it costs about twice as much as acquiring a domestic subscriber. They also have, you know, burning $3 to $4 trillion or $1 billion a year just in, you know, cash flow burn related to acquiring this new content or creating this content. So that is an issue going forward in terms of how they're balancing out these costs and issuing debt and how that drives the top line in terms of revenue and profit growth.
But it is hard to argue with some of that stock performance the last few years. Dan Morgan with Synovus Trust, thanks again for your thoughts tonight.
Thank you, Bill.
Otherwise, it was a mixed day on Wall Street. The Dow got a lift from the financial sector, which saw better than expected earnings from Bank of America. We'll have more on that in a little bit. But the broader market struggled for gains, weighed down largely by energy shares. The Dow at the close rose 44 points, still above 25,000. The Nasdaq fell by 20, and the S&P was down 2. Speaking of energy, the price of crude oil fell sharply today after the Treasury Department said that some oil buyers could get waivers to continue buying Iranian supplies despite the sanctions that were recently put back into place. During the trading day, of course, investors closely watched that joint news conference in Finland held by President Trump and Russian President Vladimir Putin. The event itself was deemed politically controversial, but it didn't shake Wall Street. Eamon Javers has the story tonight in Helsinki, Finland.
Yes, I did. Yes, I did.
With those words, Russian President Vladimir Putin confirmed that he was rooting for Donald Trump to win the 2016 presidential election, a confirmation given as he stood alongside Trump at a post-summit press conference in Helsinki. The specter of the 2016 presidential election and what the Russians did or didn't do to interfere hung over the first summit between the two men. President Trump said he still isn't convinced that Russia was responsible for hacking into Democratic computers during the election.
Said, all I can do is ask the question. My people came to me, Dan Coates came to me, and some others. They said they think it's Russia. I have President Putin. He just said it's not Russia. I will say this, I don't see any reason why it would be.
Swift and largely negative reaction from Democratic lawmakers as well as members of the president's own party.
Putin only understands strength, and I did not think this was a good moment for our country.
Senator John McCain said no prior president has ever abased himself more abjectly before a tyrant. Trump acknowledged that the meeting with Putin was politically perilous for him, but said he wanted to turn U.S.-Russian relations for the better.
Our relationship has never been worse than it is now. However, that changed as of about 4 hours ago. I really believe that. Nothing would be easier politically than to refuse to meet, to refuse to engage, but that would not accomplish anything.
Putin said there was no evidence of Russian collusion with the Trump campaign and extended an unusual offer. He would allow U.S. law enforcement to come to Russia and participate in an interview with the 12 Russian intelligence agents indicted by the Department of Justice last week if Russian agents were allowed in turn to go to the United States and interrogate Americans. Putin was asked if he had any compromising information about Trump, and he dismissed the likelihood, but did not explicitly deny that he did.
Yeah, I did heard these rumors that we allegedly collected compromising material on Mr. Trump when he was visiting Moscow. Well, distinguished colleague, let me tell you this. When President Trump visited Moscow back then, I didn't even know that he was in Moscow.
After the press conference, a White House official emailed me to say that the president has been entirely consistent on this issue, both publicly and privately. But when he lands back in Washington, he'll face some tough criticism from members of Congress who feel this was a missed opportunity. For Nightly Business Report, I'm Eamon Javers in Helsinki.
So clearly, while the reaction was swift in Washington, there was muted reaction on Wall Street today. And joining us tonight to talk about that economic relationship we have with Russia is Zachary Whitland. He's an analyst with the Eurasia Group. Zachary, thanks for joining us tonight.
Thank you very much.
First of all, why do you think Wall Street pretty largely ignored all that was going on in Russia today?
Wall Street should ignore the main results of the summit today because the largest part of the actual results here were agreeing to keep on talking. The main linkage between what happens in the U.S.-Russian relationship and markets is the sanction situation.
Right.
And we already knew going in that because of congressional legislation passed last year, Congress has a veto over actually removing those sanctions. And that leaves the main question being how likely is it to keep ratcheting up the pressure and how likely are new sanctions here?
Well, that's the question I want to ask you, because the President Trump doesn't have the ability to remove those sanctions while President Putin is desperate for them to be removed. Are they going to be at some point, do you think?
I think it's highly unlikely. In order for the sanctions to be removed, first, the traditional benchmark is fulfilling the peace process for Ukraine, which remains stalled and doesn't seem to be picking up too much. talks are happening, but I'm not too optimistic about that. Several other factors have also entered the relationship, making it hard to untangle the main reasons for which there are sanctions right now. That includes escalation in Syria, it includes accusations of cyber attacks, it includes the electoral interference issue as well. And nothing that happened today is changing the outlook for those.
Now, President Trump, while he was in Europe, was advocating for Russia to become a member of the World Trade Organization and to be returned to the G8. Again, is that likely to happen, do you think?
Probably not, because for Trump himself to push for that, the other members of the current G7 would have to agree to it, for one thing. And Trump's views here still remain fairly at odds with the rest of the national security community, and even to an extent with members of the Republican Party, which still holds Congress.
And even as this happens, I know several business people who go to Russia. They see tremendous opportunity for business with Russia. So how do you characterize the opportunities that exist for people in the United States when it comes to Russia in terms of investment and business?
Well, Russia's macroeconomic team, particularly their central bank, has done the textbook, orthodox, possibly even best possible response to dealing with the oil price shock that was devaluing the ruble relatively quickly, with some back and forth over that when oil prices collapsed and sanctions came into place in 2014. The central bank has done a decent enough job of managing the ruble as well. And also, it's because of trends in oil prices and the way in which the linkage between oil and the ruble has somewhat weakened over the past year. Russia's remained fairly cheap for businesses, and that remains an attractive feature. Reserves are still decent. Repayment risk is, I think, fairly low compared to other emerging markets when we talk about fixed income bonds, the OFC as they call it in Russia. And so the existing opportunities are still there. A lot of multinationals certainly were not in a hurry to get up and quit. But the political environment, particularly sanctions, still weigh on it. And it remains a risky place. There are deficiencies in the business environment, absolutely. You don't want to go in the court system in Russia. And those things are unlikely to change either.
Zachary Whitland with the Eurasia Group. Again, thanks for joining us tonight.
Thank you very much.
Elsewhere, a new report says that China's economy expanded by 6.7% in the second quarter. And while that sounds like solid growth, it is down slightly from the first 3 months of this year. Some economists are troubled by the drop-off in business activity and domestic demand there. Government is also, of course, putting in new policies to support the economy in an effort to fend off the effects of the escalating trade fight with the United States. And speaking of which, Beijing has filed a challenge with the World Trade Organization against the White House's latest tariff threat. Chinese government is responding to the proposed 10% tariff on $200 billion worth of Chinese goods that was announced late last week. The Trump administration has criticized the WTO in the past for being unable to deal with China, implying that this challenge might have little impact in Washington as well. As for the tariffs on steel products already in place, apparently they're starting to take a toll. And that's especially true for one business owner who talked to our Kayla Tausche.
The steel rods arriving here in Wilmington, Delaware are from Italy. The price of this 10,000-ton delivery to Metal Partners went up by an extra $1.5 million because of the new tariffs. CEO Frank Berggren has had to make adjustments.
Until May, I didn't know if I was going to be paying the tariff on it or not. Now, unfortunately, with this cargo that you see coming in, I do have to pay the tariff on it.
The costs are adding up for Metal Partners, which paid an extra $1.6 million on a shipment from Turkey in May. The company plans to pass the increased cost to customers, but for now it's paying the price. The problem, it has to go outside the U.S. to get enough raw steel to meet customer demand.
I would buy all my steel from domestic mills if I had the option. The reality is that the capacity isn't in place to meet it.
Companies have made some 30,000 requests to the Commerce Department to be excluded from tariffs. Metal Partners is one of them.
The process is quite tedious to get through.
Commerce Secretary Wilbur Ross suggested to lawmakers that most requests would be denied. So far, only 220 have been approved, and they expire in a year. Indiana Republican Jackie Walorski has pushed to streamline that process and lower costs for businesses. According to Walorski, Secretary Ross said higher prices had a silver lining.
A few weeks ago, we were in a meeting. Secretary Ross was there, and he announced to some of my colleagues and myself that, there was good news. And the piece of good news was the Treasury has received almost $1 billion in tariffs. The problem was that I pointed out that's American money. That's from small business in my district.
In the meantime, business owners like Bergeron are paying tariffs on imports and higher prices for domestic steel, if they can get it.
We have a serious supply issue within the U.S. domestic market today. Without the imported steel coming in, that is the primary driver as to what's inflating the prices as quick as they are.
The Commerce Department says more U.S. steel should be available by the end of the year. But for businesses like Metal Partners, time is money. For Nightly Business Report, I'm Kayla Tausche in Washington.
Time to take a look at some of today's upgrades and downgrades, and we begin with UPS. Their rating was upgraded to buy from neutral at UBS. The analyst there cited revenue growth and potential cost savings from new initiatives. Price target $125. Shares finished today up 1.5% to $110.65. But that same analyst who upgraded UPS downgraded rival FedEx to neutral from buy. The firm cited the company's global footprint, which it said makes it more susceptible to trade wars. Price target $256, and shares of FedEx dropped 1.5% to $230.18. Meanwhile, Wells Fargo was upgraded to outperform from market perform at KBW. The analyst calls the stock's valuation compelling, says Wells Fargo could return to best-in-class status among the money center banks by 2020. Price target $63. The stock rose nearly 3% today to $56.98. Still ahead, an industry that is climbing to new heights.
A big day of orders here at the Farnborough Air Show. Are the defense and aviation sectors moving into an extended super cycle? I'm Phil LeBeau. I'll have that story coming up.
Goldman Sachs is expected to name David Solomon as the firm's next CEO. Solomon is currently Goldman's president, and according to reports, the announcement could come as early as tomorrow when Goldman Sachs reports its earnings. The New York Times says that current CEO Lloyd Blankfein will stay on during a transition period. Blankfein has been CEO for 12 years now, making him the longest tenured CEO of a major Wall Street bank. Lower costs help Bank of America top earnings estimates, and that's where we begin tonight's market focus. Those savings and a rise in loan growth at higher interest rates helped the bank's profits rise at a faster than expected clip. Revenue also inched higher in nearly all of its divisions, and shares rose as a result by 4% to $29.78. BlackRock said that higher fees and strong performance in its technology services business helped it turn a better than expected profit, but the world's largest asset management also said that less demand for its ETFs as investors wrangled with market uncertainty last quarter. That took a toll. BlackRock shares fell as a fraction as a result of $503.96. Higher shipping rates and more deliveries helped transportation company J.B. Hunt top earnings expectations, even as it operated a smaller fleet of trucks. Shares were initially higher, but did reverse course on analyst concerns that the company did not raise guidance and that the truck market may have peaked at this point. They finished off about 0.5% to 121.13 today. Valiant Pharmaceuticals officially changed its name today to Bausch Health and began trading under the ticker symbol BHC, all in an effort to distance itself from a number of accounting and drug pricing investigations that happened under previous management. Bausch said, though, it is on the right path.
The first quarter, we've shown organic growth. Last quarter, we've also now increased our investment in research and development. And importantly, we did reduce our debt by $7 billion just in the last 2 years. So we do think we're making great progress. There's still a lot to do, to be clear. But we think today being day one of our Bausch Health captures the 165 years of the legacy of innovation in healthcare. So we're excited.
Shares fell 1.5% today to 23.05. And Sinclair Broadcast's proposed merger with Tribune Media has hit another regulatory roadblock. FCC Chair Ajit Pai says that he has serious concerns with the nearly $4 billion deal and doesn't plan to approve it at the way that it's currently structured. The FCC will consider having an administrative law judge review that deal. Sinclair Broadcast shares were off nearly 12% to $29.10. Meanwhile, Tribune fell by 16% to $32.12. The aviation industry is in the midst of one of the longest and most profitable runs in its history, and the ascent may not be over yet. Many experts say the industry's fortunes could climb even higher despite the overhang of rising trade tensions. Phil LeBeau reports tonight from the Farnborough Air Show outside of London.
Pardon the pun, but the global aviation market is soaring to new highs. At the Farnborough Air Show, Airbus has announced orders of at least 17 A350 airplanes with a book value of $9.2 billion. Boeing has booked $11.6 billion in orders for 68 planes.
We're seeing a strong marketplace. We're predicting an $8.1 trillion market over the next 10 years. We think the world's going to need close to 43,000 new airplanes over the next 20 years. That's an increase in our estimate.
Why is business taking off? On the defense side, countries are increasing military budgets, especially as President Trump calls on allies to pick up more of the cost of global military alliances. Meanwhile, the commercial airline business keeps growing as the number of people flying is increasing due to a strong global economy and relatively low airfares.
We're in a super cycle right now. We have to be honest. Demand is up 7% again, forecast in 18 after an 8% growth in demand for air travel in 17. So, you got to make hay when the sun shines.
But keeping up with that demand will not be easy, because as plane makers like Boeing push to build more planes each year, engine makers like GE will also have to expand production.
And that's not a problem for a large company like GE or Rolls-Royce. The challenge will be getting smaller suppliers to spend billions of dollars in order to build more product. The solution? More mergers and acquisitions, with larger aviation firms buying smaller companies.
There's going to be a consolidation at all levels in the supply chain to do what the Boeings and the Airbus are going to demand out of them.
Reaching new highs in an industry looking to break a long history of up and down cycles. Phil LeBeau, Nightly Business Report, Farnborough, England.
And Arconic today signed its largest supply contract ever with Boeing. The company is going to provide aluminum sheet and plate for all models produced by Boeing commercial airplanes. Separately, the Wall Street Journal reports that Arconic has drawn takeover interest from private equity firms, and that's what helped send those shares higher. It was one of among the best performing stocks in the S&P 500 today, up more than 10% in today's session. Coming up, one of the hottest parts of the already steamy real estate sector. Amazon's Prime Day started today with some glitches. Customers reported that the site was crashing on what is among the busiest shopping days of the year for the e-commerce giant. And despite the glitch, Amazon shares rallied to their 4th straight record close and 8th straight day of gains. In fact, so far this year, that stock is up more than 55%. Meanwhile, Amazon Prime Day means a lot of stuff's going to be shipped over the next several days, and all of that stuff has to come from somewhere. That's why the warehouse sector is heating up. In fact, a new report shows that demand for warehouse space is now outstripping supply. And as Diana Olick reports, that means the value of warehouses is climbing.
It is arguably the least sexy sector of real estate, but warehouse is hotter than ever. Demand for space for all the stuff we order has rents rising globally, now up 3.2% annually, according to CBRE, a commercial real estate firm. That is up from 2.2% a year ago. While growth in e-commerce has been the big warehouse story, there's now even newer demand.
We have something that we call local is the new global, things like microbreweries, where people are forming small businesses into some of these industrial or light industrial centers.
Levy has been in commercial real estate for 22 years and said he's surprised at not just the demand, but that the average warehouse lease is getting longer.
Why is that?
And that's because the demand is so high, landlords have the ability to drive not only higher rents, but longer term contracts to stay in there, which makes these buildings not only more valuable from a demand standpoint, but from a capital market standpoint as well.
Rent growth is highest in Canada, Asia, and Europe, where there's less supply, but 3 of the top 10 rent gainers globally are in the U.S., pricey markets where land to build on is scarce.
There is plenty of land out in America to build warehouses on, but so much of the demand is coming from big cities where land is limited. And that's why developers are now starting to think, rather than build out, why not build up?
Which is exactly what Prologis, one of the biggest warehouse REITs, is doing in Seattle, planning a multi-story warehouse because higher is better. This may also be in store for areas around airports where the most valuable goods are transported.
If you follow the airplanes, you are following the money. So we see airport as industrial as a segment of the market that's very attractive.
Airports, big cities, and close-in suburbs, all hot because if you build it, no question, more stuff will come. For Nightly Business Report, I'm Diana Olick in Capitol Heights, Maryland.
Before we go, a final look at the day on Wall Street. Kind of a flat day, but there are a lot of earnings coming this week, and Fed Chair Jerome Powell will be testifying before Congress this week as well. Could get some fireworks. The Dow rose 44 points today. The NASDAQ was down 20. The S&P down 2. That is Nightly Business Report for tonight. I'm Bill Griffith. Thanks for watching, everybody. Have a great evening. Hope to see you again tomorrow night.